If you're an investor in the EU, you've probably felt it. That nagging feeling that something just isn't lining up properly. You dive into videos and you read articles, and everyone seems to be talking about these nice US listed ETFs with their fancy tickers and their tech-specific benefits. But then you try to buy them here in your EU broker and they're just not there. Or maybe you find something that's similar, but you just can't be sure whether it's the right thing. And this isn't just you, it's a common frustration. I sure ran into it when I started. The world of exchange-traded funds is fundamentally different, whether you're in the EU or in the US. And today we're going to clear up that confusion and break up the difference just for you, an EU investor right here in the EU. When it comes to investing in Europe, the most important idea is probably getting familiar with the UCITS. This acronym stands for, and let me read it off, Undertakings for the Collective Investment in Transferable Securities. It's a mouthful, but in the end it's basically the EU regulators' way to protect small retail investors like you and me. On another note, this isn't financial advice. I have to say that for the regulations, especially in a video about regulations. If an ETF is UCITS compliant, it simply means it follows a bunch of rules. And these aren't just suggestions, they are legally binding safeguards. And here are some of them that make the UCITS so robust. The first is diversification. To be UCITS compliant, an ETF has to be highly diversified. It means it may not hold more than 20% of its securities from one single issuer. There are exceptions where it can go up to 35%, but 20% is the usual case. This prevents over-concentration and makes it safer in general. The second is liquidity. A UCITS compliant fund must be liquid. That means they must be able to be easily bought and sold. That way, when you want to buy or sell, you won't suddenly stand there without being able to do anything. The third important part is transparency. An UCITS compliant fund is forced to give out comprehensive information about itself. This is found in the Key Information Document, the KID. This is a standardized and short document listing out the fund's goals, objectives, risks, costs, and previous performances in plain language. Without a KID, an US ETF is not allowed to market itself to European investors. And the last one I'll shed some more light on is an independent custodian. UCITS's funds assets must be held by an independent third party from the fund manager, usually by an independent custodian bank. That way you have an extra layer of security, ensuring your assets don't go up in smoke even if the broker suddenly goes bankrupt. These regulations mean that most ETFs available to retail investors in the EU must be UCITS compliant. And that is also the reason why you can't just buy those popular US listed ETFs directly. This framework is designed for investor safety and standardization across the EU, which is of course a huge benefit, but it also means that you have to go around looking for EU versions of those US funds. Because of these UCITS regulations and other stuff like MiFID2, EU investors often have different access to products and markets compared to their US counterparts. You'll still find an abundance of EU domiciled ETFs that track various major global indexes, sectors or themes, but they're all structured to meet EU rules. Which brings us to the big US content trap. Just picture it, you're watching a fantastic YouTube video about a portfolio management strategy and breakdown, and the host enthusiastically mentions ETFs like SPY, the SPDR S&P 500 Trust, or the Vanguard S&P 500 ETF VOO, which usually was the one I had intended to use, but I couldn't find it. Both of these are massive, highly popular, low-cost ETFs in the US. So you get excited, you open your broker, you tap in SPY, and what do you find? Nothing. Or worse, something that looks similar, but you can't really be sure if it's SPY. And the reason for that is simple. US domiciled ETFs don't produce a KID that complies with the EU regulations, and without that KID, they just aren't available here. Brokerages are legally prohibited from selling those to EU retail investors. And the core issue we arrive with that is that a significant portion of the finance content on the internet is simply targeted at the US. They discuss US tax situations, like capital gains rules that just don't apply here, US only brokerage accounts, and most critically, US domiciled funds. And while the underlying investment philosophy might be universal, I mean, it's reasonable after all, the specific tools and vehicles aren't. They don't translate well. So always approach general investing content with a grain of salt, and before you try to do anything, verify the local rules for yourself and ensure that the products mentioned are available and suitable for the EU. So knowing all this, how do you actually find a suitable ETF for your portfolio? Here are some key characteristics to look for. The first is the UCITS label. It's an absolute key. Usually the name will always include UCITS in it at some point. Ensure that that is there. For example, instead of the iShares S&P 500 ETF, which is the US version, you would have to look for the iShares S&P 500 UCITS ETF, which is the EU version. When they have that in the name, it directly tells you that they are designed specifically for the EU market. The second part to look out for is the fund domicile, usually Ireland or Luxembourg. Now, this is an important thing, especially for taxes. Many popular UCITS ETFs or US tracking ETFs are domiciled either in Ireland or Luxembourg. But why does this matter? First, the Irish domicile. Ireland has beneficial tax treaties with the US, and for US listed companies, dividends paid to an ETF that is domiciled in Ireland are subjected to a 15% tax cut. But the normal rate is a 30% tax cut. It would apply if your ETF were domiciled somewhere else where there is no such treaty. Those 15% are usually handled internally within the fund, and you generally don't have to bother with it. And over years or decades, this 15% tax difference can really boost your income, especially for dividend-paying ETFs. And Luxembourg is also a very common domicile because it offers similar benefits and also a strong regulatory environment. The third important difference is accumulating versus distributing. Most ETFs will have both versions available and you'll have to pick which one you want. This is also a critical choice because it decides how your dividends are handled. How do accumulating ETFs work? When the companies of the ETF pay out dividends, the fund itself reinvests those dividends into buying more company shares. That means you don't get paid out any money, but the value of your shares will rise, which is in addition to the normal growth of value in your own shares. This is often preferred by long-term investors because it allows you to tax efficiently compound your earnings. Because no money gets paid out, no money gets taxed. Generally, you only pay taxes on an accumulating ETF when you actually sell your shares and make a profit, which is again depending on your country's tax laws. The other option are distributing ETFs. With those, the funds you invest in regularly pay out the dividends. And if you need or simply want regular income, a distributing ETF is a pretty solid choice. However, you have to keep in mind that you will have to pay taxes on the dividends as they get paid out, which over a long time can be less growth efficient than an accumulating ETF. And for most beginner long-term investors, accumulating ETFs simply are the better choice because, well, they are lower effort, You don't need to think about them, you don't need to do the tax math, you just watch the number go up. The fourth important is physical versus synthetic replication. This refers to how a fund actually tracks the underlying index. First option, physical replication. In this case, the fund actually physically buys the shares of the underlying tracker. For example, an S&P 500 fund will buy shares of the S&P 500 companies. This generally is considered simpler and has a relatively lower risk. The second option is synthetic replication. In this case, the ETF uses financial derivatives, such as swap agreements, with a counterparty bank to reproduce the index's performance. And just from that sentence alone, you can already tell that it's a lot more complicated than just buying the shares. In this case, the ETF doesn't hold the actual stocks. And while often efficient, this method introduces the counterparty risk, which is the risk that the other party with which you have the financial product goes bankrupt. And for beginners, physically replicating ETFs are generally recommended because it's just simpler and it has less risk. And honestly, I can understand why. The fifth point is the total expense ratio, the TER. This ratio represents the annual costs of holding the fund. And for a broad market index ETF, you should look for those with an TER below 0.2 or maybe even below 0.1% per year. These percentages might sound small, but over the years and decades, they really eat into your profits. So cheaper is better, of course. And the sixth thing to consider is the brokerage availability. Just because you hear about a fund doesn't mean that every broker around will also offer them for you to buy. So before you commit to a fund, you should check whether it's even available in your broker. Most popular options have a massive list, but it doesn't mean they have everything. A generally overlooked and, to be honest, in my opinion, not that important point is also currency hedging. Some UCITS ETFs come in both a hedged and an unhedged option. An unhedged ETF, for example an S&P 500 in euros, means your investment is exposed to currency fluctuations between the euro and the underlying currency of the asset, which for example would be the dollar for US stocks. If the US dollar weakens, the value of your investment will go down. If it goes up, it goes up. A currency hedged ETF will try to mitigate these changes and fluctuations by using financial instruments to lock in the exchange rates. For long-term investors, unhedged is usually preferred because for one, it's simpler, and for two, over a longer period of time, those currency fluctuations just tend to even out. However, if you have a strong view on currency fluctuations or you are investing in a fixed income, a hedged version might be worth considering. So let's bring it all together. As a beginner investor navigating the world of UCITS ETFs, UCITS is your essential identifier for rule-abiding funds. Be acutely aware of the US bias in finance content and seek out the equivalents for the EU. Prioritize the ETFs in either Ireland or Luxembourg to maximize your tax benefits and advantages. Number 4. Understand the difference between accumulating and distributing ETFs and choose which one you want. Consider the physical replication for simplicity's sake. Number 6. Always hunt for a low expense ratio. No point spending money you didn't need to spend. And finally, understand currency hedging and decide whether it's aligning with what you want to do. Navigating the world of ETFs can be overwhelming at the beginning, no doubt. But now that you are armed with this knowledge, you are much better equipped to make informed investing decisions that are perfectly suited for your situation and your objectives. In the end, it all comes down to your own thoughts. So tell me, did this deep dive help clarify things for you? What other EU-specific or general investing topics are on your mind? Let me know in the comments down below. And don't be the bank's favorite customer. I'll see you in the next one.